Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about 4 myths that many people have with regard to registered retirement income funds or RRIF accounts. So these myths can get in the way of us making good quality decisions around the RRIF account. So let's look at myth number 1, and that is I can't open up my RRIF account until I turn age 71. So there's a lot of misunderstanding around this one. So a lot of times people think they have to take income at age 71, which is not the case. So you do have to move money from your RRSP accounts to a RRIF account in your 71st year. You don't have to take your first payment until your 72nd year. However, you can open up a RRIF account long before that. And in fact, even if you didn't need the income before age 72 or age 71, there may be value in beginning to generate some income from your registered retirement savings plans through a RRIF, so you can take advantage of the pension income tax credit. So $2,000 credit that you can access if you're generating pensionable income from your RRIF account from age 65 on. As well, some people don't have a lot of income in the first few years of retirement, particularly before their Canada Pension Plan and Old Age Security kicks in. So in those circumstances, it may in fact make sense to take RRIF payments earlier so that you can take money out of your RRIF account or RRSP account that's converted to a RRIF out at a lower marginal tax rate. Now, the second myth that circulates around there a little bit is that opening up a RRIF account is complicated. It's actually not very complicated at all. And if you've got an advisor or a financial institution that you deal with, the paperwork is actually quite seamless. Now, although the paperwork is straightforward and easy to work through with your financial institution, there will be some questions that you need to reflect on before you complete the paperwork. And you may want to think about these things before you actually go to your financial institution or before you RRIF some of your RRSP capital. The first thing is, what kind of flexibility do you want to have with your RRIF account? So if I walk into my credit union or my bank branch, the flexibility might be more limited because they want to talk to you about their proprietary in-house products and services. Alternatively, if you go to an independent financial planning advisor, an investment counselor, a securities advisor, they'll typically open up a RRIF account that is self-directed in nature. It doesn't mean you have to self-direct it, but the account will allow your advisor or institution to hold a mix of investments from various institutions. So you can have GICs or mutual funds or exchange-traded funds, stocks, bonds, all within that account. So if you want maximum flexibility with your RRIF investment strategy, that might be the kind of account that you want to settle on. The other thing is you'll need to focus on beneficiary designations. So if you have a partner, you'll likely appoint them as a successor annuitant, which means they'll continue to get the income if you pass away. Or you might have a direct beneficiary, which might be children. Or it may make sense for your estate to be the beneficiary of your RRIF capital. Again, your advisor will be able to give you some guidance and clarity on those strategies. And if you look at our videos on our YouTube channel, we do talk about RRIF beneficiary designations. Now, the third myth is one in which people think they have to cash out all their investments from their RRSP accounts when they move their money to a RRIF plan. And that's not the case. So when you have to move money from your RRSP to the RRIF, it can be done as an in-kind transfer. And that simply means that whatever securities or investments are in your RRSP, you can transfer as is into the RRIF account, and they can continue to compound. Now, once the money's in the RRIF, there will be a required income payment. For example, let's say you RRIF your RRSP capital at age 71. In your 72nd year, you'll have to take out 5.28% of the RRIF's value January 1st of the 72nd year. And so you'll have a minimum payment that has to come out of the portfolio. Now, when that payment comes out, even there, you don't have to necessarily have a lot of cash to fund that payment. Let's say you don't need the income, but you have this required minimum that you have to pay out. Well, that too can be an in-kind transfer. You can transfer the asset out as is, and the only piece that has to be cashed in is if you have a tax payment that you want to be remitted to CRA from your RRIF account. But even on the RRIF minimum, you do not need to make tax remittances directly from your RRIF account. You do if you have payments above the RRIF minimum, but if it's below or at the RRIF minimum, you can just do an in-kind transfer from the RRIF to your open investment account as is. Now, obviously, there will be requirements for cash transfers from your RRIF account. So you want to take a look at your retirement plan, and if your RRIF plays a role in supplementing your other pensions and cash flow needs, then you'll need to have at the ready within the RRIF account very conservative cash-oriented assets that are ready to pay out when you need the income from the portfolio. Now, the fourth myth is that you have to change your investment strategy when you move money to the RRIF account. It's somewhat related to the third myth. You do not need to change your strategy in any major way. So whatever investments you're using for your RRSP account, they can be used for your RRIF account. Now, in saying that, there will be some fine-tuning and potential adjustments to your RRIF account. And that's because you will probably be putting now some pressure on that account to kick out income to you. And like I said in the previous point, if that's the case, you need to look at your portfolio and begin to plan out what needs to come out, what's the timeline. With those investments, you probably want to be a little more cautious with your strategy. So there might be a little bit of fine-tuning, at least on a portion of the assets that are going into your RRIF account. Well, it's my hope that you found this video helpful, and if you want more information about retirement income planning, don't hesitate to click on the helpful links that are in the show notes for this video. And if you like the video, make sure you click like. If you want to subscribe, make sure you click the subscribe button. You take care. All the best in your retirement income planning.